Welcome back to Primary Source China Investment. This week, peng.guo and I are on show Q4. And despite what we said last week and about not talking about the two sessions, this week we're going to talk a little bit about what happened and the result of that. And what happened specifically has to do with regulations. And regulations evolve. And we want to compare the regulatory environment in China with the regulatory environment in a place like Europe. Tech firms in the US are constantly running up against EU regulatory issues. Recently, Google, Meta found out that they'll have to conform to something called the Digital Markets Act and the Digital Services Act. Apple will have to allow other platforms access to the Apple Store. Everything from chargers to content to algorithms. The US companies are finding it more and more difficult to do business in Europe. China's approach for much of the tech space has simply been to pass laws and ban those tech companies. At the recent two sessions, though, it became clear that China's regulatory environment has entered a new era. So, peng.guo, with that comparison, the EU and China, what are companies going to do going forward in order to run their businesses on the ground in China?
In China, it looks like it's not just one area get changed, it's the entire China governance structure get changed right now. That's a couple of the goals. I think first time is improve the efficiency, and the second time they try to optimize the different department and different regulation areas functions. So this is really like the optimize and the reconstruction the process. So the many consideration behind that. The third thing is the regulations. It's harder to keep up with the tech improvement. So tech is developed so quick. A lot of things they cannot keep up with that. They always suffer such kind of problem.
The reason I bring up the EU is because if you want to sell everything from toothpaste to televisions to construction equipment to financial services, you have to be in compliance with the EU laws. Similarly, China is going down that way also. You have to be in compliance with local laws. And I want to say this at the outset. It should be said that no other country has done more to assist the rise of China than the United States. From Nixon's trip in 1972 to Clinton's push for China to join the World Trade Organization, no country's done more for the rise of China than the United States. But certainly since the kickoff of the trade war in 2017, the relationship has been evolving. The US side is beginning to realize that no amount of trade is going to bring on democracy. And in fact, it's probably exposed the deeper philosophical divide between the US and China. And for China's side, particularly Xi Jinping, he's no longer willing to tolerate what Beijing believes are infringements and encroachments on China's interests. So those are the sort of the framework that companies are trying to deal with. And then from companies, we'll look at investors. At the joint session in Beijing, two new regulating bodies were announced, one for financial services and the other for tech. So we're going to get into that a little bit right now. The latest, this is a little bit inside pool, so just bear with me for a minute, peng.guo. The latest plan calls for the establishment of the National Financial Regulatory Administration, which replaces the China Banking and Insurance Regulatory Commission and expands the role. And this is where that expansion is going to happen. Protecting financial consumers, strengthening risk management, and dealing with violations of the law. The new regulator will also take over these responsibilities from the CSRC, but the CSRC will remain. What has also been happening is China, and we covered this in a previous show, China's been encouraging more and more foreign investment, particularly in financial services space. So if you're sitting there looking at China and you're a foreign institution, you're looking at a changing regulatory environment and also the invitation to come and do more. So what does that mean from a practical perspective? It means more boots on the ground, more people committed to China, more investment, not only in terms of money, but technology, people, resources on the ground in China.
That's like the national financial regulation administration is really trying to replace the China Banking and the Insurance Regulation Commission.
Right.
So that's it. But they also have the more extension power to consolidate and regulate all the non-CSRC activities.
Right.
So this is really the goal. And the rest of those things is just the central bank. So central bank's goal is pretty straightforward. I don't expect a lot of the change in the regulations, but I hope them can do more consolidation and reduce the process and reduce the redundant work. I think it should be a good way to improve the efficiency. And also, they try to cut the salaries of the people because that's too much cost for the government employees.
Well, one thing I can be certain of, more and new regulations never make things easier. So
absolutely.
I can't imagine. I mean, it may be the theory that things will be streamlined, and it may be all for very good reasons, but if you're on the ground trying to comply with this, the costs, time, and effort just continue to kick up.
And they also try to shift the responsibilities from the central authority to the local government and the local regulation entities. So that means every province or every major city, so their financial regulation, they have to take the more responsibility to take the serious work on that.
The other area we wanted to mention before we get out of here is the tech sector, because the tech sector also has a new regulator called the National Data Bureau for coordinating the establishment of data systems for the country and promoting the development of the so-called digital economy. That includes internet-based services. This is really about everything tech. And, the US has done some things, China will respond with some things, but being caught in the middle of that is very, very difficult to maintain your compliance. So the message that we've been sending through this channel for as long as you've been listening is find the Chinese names that have great mainland-based businesses and that face less competition. There are whole sectors out there that are completely closed to foreigners. And if we learned anything from the leadership in Beijing, they are convinced that more self-reliance is required. So that should go into your top-down approach when looking at your allocation to China. Anything you want to follow up with that, peng.guo?
Everything right now is a digital asset that people realize the value.
Exactly.
So, and it's hard to implement. So everybody knows it's important. So needed to regulate it. We see some of the progress, like the eastern side data get calculated in the western side, and then put the result back. So this just trigger a lot because the western side they have the power. They have the lot of the energy produced in the western side. So they will be used to calculate the eastern side big data. So this is gives a lot of opportunity for the data companies. From the regulation perspective, I don't think a foreign company could easily into this area. And also China looks like open like the data exchange in China, in Shenzhen.
Shenzhen, yeah.
So if you want to exchange the data and for commercial purpose, you can consider to doing like that. I would also be interested in know more about how to trade the data and in the exchange. And overall, I think that the government still try to provide the fair and open market environment to the companies to compete together. They also know the bad areas for the monopoly in those areas. I would be interested to say what's the new policies on the way and what's the impact on the entire industry.
Well, we're certainly going to look and keep our eye on Shenzhen for this data exchange. So we're going to leave it there. Thanks for tuning in this week. We'll see you next week.
Thank you.